Where's the stock market going to be in 20 years? What will the US tax system look like? How much inflation do we really need to plan for? These are big, legitimate questions. And here's the truth: I can't give you precise answers. Neither can any retirement planner worth listening to. And that leads to a very common thought. If we can't predict the future, what's the point of planning for it? Are we just spreadsheet nerds overcomplicating an unknowable world? This is what I call the unpredictable future fallacy. And more specifically, it's a red herring, a distraction that sounds logical on the surface, but ultimately misses the point. You'll hear this myth echoed in YouTube comments and probably dinner table debates. No one knows exactly what the future holds, so planning is pointless. And hey, it's not hard to find data that makes this argument look smart. If you look at rolling 20-year stock market returns, they've ranged from 0.5% per year to over 13% per year. That's a massive difference. In compounding terms, those aren't just different outcomes, they're entirely different financial universes. Or take taxes. Politicians change the rules constantly. At one point, Social Security benefits weren't taxed. Now they are. The top marginal rate was once over 90%, now it's 37%. So, how can we plan if the rules keep changing? Isn't tax planning just a guessing game about what future governments are going to do? And here's the philosophical crux of the issue. History is backwards looking, life is lived forwards. So how do you plan for a future that doesn't yet exist? This is where the fallacy actually collapses, because the real flaw isn't uncertainty, it's how we respond to it. Problem number one, this myth distracts us from the actual purpose of planning. Planning isn't about predicting the future, it's about preparing for a wide range of possible futures and stress testing your life against them. Problem number two, taken to its logical extreme, this mindset makes no sense. You drive your car each day knowing there's no guarantee you'll arrive safely. You eat healthy, exercise, get checkups, even though those aren't guarantees. So why should financial planning be held to some unrealistic standard of certainty? And there's one more correction I'd like to offer here. Real planning isn't about building a plan and then sticking to it for 25 years. It's about planning as an active process. Great planning is dynamic. You build a plan today based on what we know, but then you revisit and adjust it regularly, not just because tax laws might change, but because you will change. Your goals, lifestyle, and needs will evolve. I can tell you with high confidence what tax brackets will look like next year. Beyond that, things get a bit murkier, but that doesn't paralyze us. We plan with the best knowledge we have today, and we keep that strategy flexible. Because the goal isn't to be right about the future, it's to be ready for it. But here's the thing, the future may not be as wildly uncertain as maybe it seems. Yes, tax laws change and we're living through one of those shifts right now. But look at this chart. It shows the average effective tax rate for all earners and for the top 1%, going back decades. You'll see with the top marginal bracket in blue, there's a lot of volatility here. But notice what's quite stable, effective tax rates. Over the last 60 plus years, despite political shifts, headline-grabbing changes, the average effective tax burden for most Americans is held remarkably steady. Why? Because the government always needs revenue. A tax cut in one area is often offset by an increase in another area. It's a shell game of sorts, but the overall burden doesn't radically shift. That's quite critical for planning. When we help clients decide whether to accelerate income now or defer it into the future, we're not guessing whether taxes will be twice as high or half as much. The data shows us the tax landscape changes, but the altitude stays quite similar. That's a planning opportunity, not paralysis. Now, let's talk about returns. Are these more volatile than taxes? Absolutely. But that doesn't mean they're unplannable. A good portion of portfolio returns actually are incredibly forecastable. On the screen, I have a chart showing the beginning 10-year Treasury bond yield in blue, and then the subsequent 10-year return of intermediate bonds. As you can see, these are incredibly correlated, and this makes a lot of sense. Outside of default or big interest rate changes, you can forecast what you're going to earn from a bond. This is basically its role in a retirement portfolio, safe and dependable. Stocks are a bit more of a wild card and therefore carry a bit more volatility. On the screen, I have 20-year rolling returns for the stock market in inflation-adjusted terms. As you can see, there is a quite wide distribution of returns, but also a pattern. Low return decades tend to be followed by stronger ones. Valuations here matter, and mean reversion is real. But here's the kicker. You don't need to be able to predict markets to plan effectively. What matters is understanding the range of outcomes and designing strategies that work across most of that range. For instance, we can separate out good problems to have in planning and bad problems to have. A bad problem would be something like the risk of running out of money or there being so little growth in your portfolio that a tax strategy you performed early in retirement is no longer valid, but actually might even hurt your situation. An example of a good problem would be paying slightly more in taxes because your accounts have grown so much that RMDs push you into a higher tax bracket. Looking at a range of stock market returns, bad problems are most likely to show up in red on this histogram, and good problems are in green. So when we think about a tax strategy like Roth conversions inside of a plan, we might think about general strategies like maxing the 10% and 12% brackets anytime we have additional room. For many retirees, this is likely to be a wise strategy in most scenarios. Then we think about maxing the 22% bracket. Hypothetically, let's say this is a wise strategy in all return environments but the ones highlighted in red. So about 85% of the time it would be a wise strategy. Then we think about maxing the 24% bracket, and maybe that strategy only makes sense in 40% of the best scenarios, and so on. So which path is right? Well, this depends on your risk tolerance, your estate goals, your comfortable failure zone. But the point is, without planning, you're just simply guessing. With it, you're tying decisions to data and probabilities, not vibes and headlines. There's another important insight related to planning versus perfection. We don't need perfect or exact forecasting for strategies to win. Often we just need to be directionally sound. On the screen, I have a tax chart for a median trial for this retiree. Now, this is just one specific trial that shows exact forecasting. The odds that this is this person's exact experience in retirement is incredibly low, but we don't need to be exact to see that in all trials, this person has tax problems that can be easily fixed earlier in retirement. I would also argue that the point of planning is clarity. It might seem silly to some of you, but I've had discussions with some retirees that are unsure if they can retire, and we calculate out their portfolio withdrawal rate to be something like 2%. In safe withdrawal rate terms, this is extremely low, which means their retirement is incredibly safe. Yet most of us don't have expertise in retirement science in the same way that I'm well beyond my skis when it comes to car maintenance. Being able to show someone a plan that, hey, here's why your retirement income need is incredibly safe, but instead here's what you should actually be concerned about, is incredibly enlightening and allows everyone to navigate uncertainty better. With a plan, that person might start to panic at the next big recession is coming news story, when in reality, a news story like that shouldn't concern them in the slightest. Now, let's pivot to income planning, an area where most retirees quote unquote plan without even realizing it. Take the famous 4% rule. It's based on the worst 30-year period in US market history. But if you follow it blindly, you could end up with a legacy 10x larger than what you started with. Great for your heirs, but maybe not for your primary goal. Instead, we could use a dynamic income strategy where you start with a reasonable withdrawal rate, then adjust based on guardrails. If your portfolio hits an upper guardrail, you raise your income. If it hits a lower one, you would then tighten your belt. So this couple has $1.5 million in assets and wants to leave close to $1 million to the next generation at the end of their plan. We're looking at the simulation through a pretty bad trial starting retirement in 1968. Now we're looking at their portfolio right now, and then we'll look at their income. What I find with talking with most retirees is everyone uses some kind of rough dynamic income strategy. But again, most of that is not driven by real data, it's driven by feelings. My portfolio went up quite a bit. I think I can probably spend a little bit more. Looking at this chart, we can see some things that might surprise a layperson. In real dollars, this person's portfolio declines for the first decade of retirement, and yet they are still able to take 2 income increases signified by the green dotted lines. The portfolio continues to decline, mostly because of high inflation, and during the middle of retirement, we actually see an income cut. Portfolio later recovers, and we see subsequent income raises. Now, strip away the data and guardrails, and most retirees would assume they should be slashing their spending during those early years of decline. By doing so, they would have robbed themselves of opportunity. Opportunity that they worked really hard to provide for themselves. But that's the gap between intuition and planning. Then here we can see the monthly income experience this retiree would have had in this 1968 trial. Ultimately, with a dynamic income strategy, they were able to spend more than they planned because of smart, data-driven adjustments happening at the right times. By oscillating their spending, they shrunk the distribution of legacy values at the end of their plan, doing a nice job balancing spending during their lives while still accomplishing their estate goals. This myth that planning is pointless because the future is unpredictable isn't just wrong, it's dangerous. Because in reality, planning isn't about prediction, it's about preparation. It's about clarity. It's about giving you the confidence in the face of uncertainty. If you found this valuable, You'll love the next video. I walk through 7 realizations most retirees have in the first few years of retirement, and these can help you get ahead of the anxiety curve. Click here to learn more, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.